Good morning, everyone. Please, I'm sorry, I don't even know what's happening. I really have poor internet connectivity here, so I don't know if probably we should be having the meetings in the evenings or something. What do you suggest? Because this internet is really worrying me. The connectivity in my area is very, very, very poor. So I'd want you to suggest something so that I know what to do. You can raise your hand. Okay, so I'm
Okay.
listening.
How about 8 p.m. to 9 p.m.?
That's fine with me. I'm okay. I'm here to help everyone. So if it's going to be favorable for everyone, why not? Because I think that during the day, there's a lot of pressure on the internet. So if we could reschedule it to evenings, and then we could have probably a serene time in class, it would be better. Because this up and down, this cutting in and interrupting really destroys the class. So Abdullah is saying 8 to 9. Can I hear more suggestions so that probably we can have today's class? If there's an error again, we just take it to this evening. Please, I want to hear everyone talk. So it's about you. Okay, and I'm here to help. So kindly let me know what you all think. Okay, so it means I can actually go ahead. If there are no more suggestions or anything, let me just quickly go ahead and then continue. But should there be any interruption, we'll have to reschedule the class. Okay, Gershon is also saying that 8 to 9 p.m. is cool. Okay, so let's try and have today's class. And then if there are no more interruptions, you can start the 8 to 10 class probably from tomorrow. We'll also try that one and see. So if it works, then we just go for the one that works. Okay, so I hope everyone is okay, and then we can begin with today's class. Okay, so Habib is also saying 8 to 9 is cool. Cephas is also saying, okay, so almost everyone here agrees with 8 to 9. Okay, so what we are going to do is that we are going to have today's class like the normal 10 to 11:15. Okay, but then if the internet gets interrupted, we just have to reschedule this class to evening 8 to 9. But let's just pray that the internet is not interrupted so that we can actually start tomorrow's class from 8 p.m. to 9 p.m. All right. So yesterday, I want to go over what we did yesterday because it's actually a continuation of yesterday's class. So yesterday, we started learning about the basics of bookkeeping. And then we learned that bookkeeping is actually the recording of transactions in our business. So every time we record transactions, we're actually doing bookkeeping. But then there's a way in which we do bookkeeping. It's not only about writing the transactions. When you write the transactions, you need to assign all transactions to an account. That's where the journal entries come in. So after writing your or recording your transactions, then you will assign an account to the transactions in your journal entry. Yesterday, I showed you how a journal looks like. When we are done with that, then we go ahead to post in our ledger. So with the ledger, we have various individual accounts. Okay, so we have the cash account, we have the sales account, we have the accounts receivable. That's money that our customers owe us. Then we have the accounts payables. We have the money that we owe our clients. We have furniture accounts. We have rent. We have wages. So any form of account based on the transactions that happen in our organization. Okay, yes. So that is it. So today we're going to look at the other tools of bookkeeping. So yesterday we learned about journal entry and then posting to ledger account as two of the tools of bookkeeping. Today we are actually going to learn about about the other two, that is trial balance and then chart of account. I'm going to make it very, very simple for everyone to understand. As I always say, if you have questions, kindly let me know so that we can solve your issues and then we can move on. So as I always do, I'm going to share my screen with you. Okay, I'm going to share my screen with you. so that we can move on with today's lecture. All right. But I believe we all understand. And then I'd have loved to ask questions, but when I ask questions, no one responds. So I don't know. I'll have to hear from everyone. Anyway, let's move on. All right. And then I want to add, please, if you're having any challenges with your assignments, you can reach out to me privately and then let me know. Okay. If you're having any challenges with your assignment, you can reach out to me for any form of assistance and then let me know. So what I'm planning to do is that when you submit the assignment, then I help you work on it. Okay, so if there are any errors, I correct them for you, then I send it back to you so that at least you know how it is done. Okay. All right, so I'll send your individual feedbacks to you. I won't put them on the page, I'll send it to you and then you know. All right, great. Someone is laughing. All right, so let's continue. So as I said yesterday, we learned so many things yesterday. We learned about bookkeeping, double entry principle. Okay, so yesterday we learned about bookkeeping, the double entry principle, where we said that for every credit entry, there's a debit entry. So based on a transaction, let's say sales to a customer, you can't say that you're only going to record just one side, one entry. No, it has to be two. Every transaction has more than two accounts, at least two accounts. So there's no way you record a transaction and then you're only going to record just one. Let's say you bought items, then you just record at your cash side. No, you need to create two accounts. That's your cash account, and then the items that you bought, you can either label it supplies, or probably if it has a name and there are things that you are actually going to be buying for your organization, let's say furniture, or let's say other things that you use, you can name those accounts too. And we said that for every debit entry, there's a credit entry. You can't debit, there's going to be an error. Okay, all right. So, and we also learn about how to post in the how to post in our journal, and then how to post in our ledger as well. Okay, so today we are going to learn about chart of account. Chart of account. Chart of account is not any scary thing. When you understand what a general ledger means, basically, as I said yesterday, with the general ledger, it is information you are getting from your journal. So based on the first point is the transaction that you record. The second step is the journal entries where you enter them. Now, when you are done with the journal entry, you need to create accounts for each of the journals that you created. Okay, so as I've always been using cash and let's say furniture, when you're done, you need to go and create an account. You need to have a ledger book. So what you can do is that you can't mix all these things. You can decide to keep one book for only transactions, one book for journal entries, and one book for a ledger, so that if you need any information in your ledger, you can quickly refer to your ledger. If you're also using a computer, you can create an Excel sheet and you name the individual sheets. So one sheet for transactions, one sheet for all journal entries, and one sheet for a ledger. Okay, so I'll try and prepare one. I'll try and prepare an example and then probably share with you maybe tomorrow during the class how it's going to look like. That's if you're using an Excel sheet, so that we can all have a fair idea. All right. Yes. So the chart of account, as I was saying, after you've created an account in your general ledger for all the journal entries, then those accounts that you have, you term them as chart of accounts. Okay, so basically we are getting our chart of accounts from our ledger account. So it means that any form of transaction that we have in our organization is going to form an account for us, and that account automatically becomes our chart of accounts. So that's how we define a chart of accounts, a listing of the names of the accounts that a company has identified and made available for recording transaction in its general ledger. Okay, so let's move on here. Now, someone asks, why do I need a chart of accounts? So that you know the number of accounts or the type of accounts that you deal with. Mind you, every startup might not have the same chart of accounts. Maybe you are into online trainings, maybe you are into buying and selling. We are all having different kind of startups, or one day we might have different kind of startups. Let's have it in mind that my startup account might be different from your startup account. So if you are, let's say, selling items, it would really be different from someone rendering a service. So if you produce items, your chart of accounts might not be the same as someone rendering a service. So if I'm rendering a service, there's no way I'm going to get inventory because I don't produce items. But if I produce items, if I sell items, I produce make items and I sell them, different way. But if I render a service, there's no way I'm going to get an inventory account. That's why I'm saying that our chart of accounts starts from the kind of transactions that we engage in our various business or startups. Yes, please, I hope at this point we all understand. And for you to get a well-structured chart of accounts, probably you should also create another sheet for all chart of accounts. So this one is going to be easy. You just go to your ledger and then you list all the chart of accounts. So when you see cash, so cash is part, inventory is part, receivables is part, tools and equipment, telephone expenses, electricity, rent expense, printing and stationery. Assume that you have all these kind of transactions in your organization, then yes, of course, they are going to be in your chart of accounts. And we always have to number our chart of accounts. We can't just leave them like that. As we go further into these studies, we are going to learn about some accounting softwares, okay? And then some of us might not even need to do this bookkeeping manually. We'll have to do them using the accounting software. And I'm going to teach you how to use the various accounting softwares. Automatically, in an accounting software, the system is going to generate a chart of accounts for you based on the kind of transactions that you enter into your account, your system. And then it numbers them for you so that anytime you're looking for a particular sort of account, you can easily enter the number. So for instance, I'm looking for a particular sort of account, you want to enter some transactions in the, let's say rent. Rent will have an ideal number, let's say 010. So anytime you see 0 or you enter 010 in your system, it takes you to the rent account. Then you can easily enter in your transactions. Okay, that's an easy way of using accounting software, because the software makes things easy for you instead of doing all these things manually. So for some time now, as we've been starting the class, all that we've been doing is sort of manual. But then as we go further, I'm going to introduce to you some accounting software that can help our startups. So when we have access to these softwares, we can actually have a very simple bookkeeping. It's going to make our work very, very, very simple. And I'm going to enjoy bookkeeping. Okay, so I believe at this point, we all know chart of account. It is basically the accounts that we've recorded in our general ledger. We put them together. We summarize all of them. Then we have our own chart of accounts. I'm going to share an example of a chart of accounts over here. So for instance, this is someone's chart of accounts. When we go to assets, it has been numbered. 101 is cash, 120 is accounts receivable. When we say accounts receivable, these are monies that our customers owe us or other people owe us. That's accounts receivable. 140 is what? Inventory. Okay, we sell items, so the stock that we have available, that's our inventory. Then we have land and buildings, that's an asset. And we have equipment. So anytime there's a transaction relating to equipment, you just go to your chart of account, number 174, and then you make the entries in there. That's when you're using a software. But it's ideal that even if you're not using a software and you're doing bookkeeping manually, it is ideal that we always keep our chart of account. Then we categorize them nicely. Yesterday, I stated that we can have over thousands of accounts based on the number of transactions that we do in our organizations. But at the end of the day, every transaction or every account must fall under the 5 main types, the 5 main accounts. We have 5 main accounts, that's the assets, the liability, owner's equity, revenue, and expense. So out of all the accounts that we have registered or entered in our journal, we need to categorize them under the 5 main accounts. So there's someone's chart of accounts. Okay, so under assets, these are the kind of accounts the person is dealing with. So it means that when I go to the person's general ledger, I need to see cash, I need to see accounts receivable, I need to see inventory, I need to see land and building, I need to see equipment. The reason for doing all these things is that it helps us to prepare our financial statement, because in our statement, we're not going to list all the accounts that we have. We need to categorize them. That's why we have 5 main accounts that we categorize these other sub accounts into. Okay, good. When we come to liability, it means money that we owe people. We can owe our workers, people that work for us, and we can also owe our suppliers, that's our creditors. Our creditors fall under our accounts payable. Then we number it. The reason for numbering is that it makes our work very, very organized. So anytime I'm looking for an account, there's the number. Okay, so what we can do is that when we create the ledger, then we give them the numbers. So when I create my ledger, when I create a very big sheet which entails my ledger account, then I know that 101 is cash, 120. So when I see 120, I know that everything under 120 is for accounts receivable. And it makes things organized. When you're looking for transactions, you're looking for details. In the moment you look out for these numbers, it helps you to know the kind of account you have your transactions in. Okay, then we have our owner's equity. So if it's a sole proprietorship, it's your own business. Sometimes the owner can take money from the business funds and then not to spend or not, but then when you spend, you definitely need to reimburse the company. That's why it's best that you don't mix your personal money with the company's money. And then our revenue, and we have our expenses. So this is just an example of a chart of accounts. Based on the assignment I gave to you yesterday, when we draw up our ledger account, we will automatically get our chart of account very easily. And then I'll give you an assignment on that. But then based on what you bring to me, I will assist you. So if you prepare, when you're able to submit your assignment, then I can also assist you in preparing your chart of account. So it will make your work very easy for you. All right. So this is another example of a chart of accounts. It differs, as I said. It depends on the kind of business that you are into. It will differ. So if you can't go to someone who is into products and you are into running of services, and then copy the same your chart of accounts right from the kind of transactions that you are dealing with. Okay, so right now we are done with another tool of the bookkeeping. So we now know journal entries, we now know the general ledger, and we now know our chart of accounts. Then the last but one tool of bookkeeping is the trial balance. It is a trial balance. It is a trial balance. What is a trial balance? A trial balance is a list of closing balances of ledger accounts on a certain date and is the first step towards the preparation of financial statements. All right, as I said yesterday, with your ledger account, we take every information from our journal. Okay, so once we enter every transaction in our journal, automatically we go and post them in our ledger account. We go and post them in our ledger account. Great. So at the end of the week, it depends on when we really want to have our reporting, but I'll suggest that it is done monthly so that it doesn't confuse you. So you can create your ledger accounts monthly, or you can have a monthly records of everything. So at the end of the month, you need to close your account. Then you start again. Okay. Then when we are done, finally, at the end of the year, we have our closing balance for the year. But for now, when we start on a monthly basis, it will help us so that things will be smooth for us. But if we pile up everything and we wait till the end of the year, things might become cumbersome. So let's assume that we have our ledger account and we now want to prepare a trial balance at the end of the month. We go to every single account in the ledger account. So as I said, we will go to cash. We'll go and sum up all the debits in cash, all the credits in cash. We go to, then we look out for the difference. The difference is what we take to the trial balance. Then we go to another account. It can be rent. Then we close the account, all the debits, all the credits. Some of the, for instance, things like expenses, it will be hardly for you to get credit because for every expense, you debit the account because that particular expense item is receiving. So if you are paying electricity bills, your cash is going out and your electricity is receiving the cash. So for most of the expenses, your account is going to be a debit account. So at the end of the month, you close all your accounts. So you close the ledger account, you close your cash, you close every single account that you have in your ledger, you close it. And then when you are done, you just take them, you prepare a trial balance. And I'm going to see how, we'll see how a trial balance looks like. And I'm going to take you through the trial balance. Okay. So a trial balance ensures that the debit balance and the credit balance in the ledger should match. If not, there may be some 1 or 2 errors. So if at the end of the month, your trial balance is not balancing, then there's an error. Your credit balance should be able to match your debit balance when you are done. And then also you should have the following columns in your trial balance. You should have assets. And let's remember that all assets have a debit balance. All liabilities have a credit balance. So at the end of the day, in your trial balance, anything classified as an asset must have a debit balance. Anything classified as a liability must have a credit balance. Anything classified as an expense, and we know our expenses, utilities, wages, rent, printing and station, any form of expenses that we incur in our business as we render services, as we produce goods, any services that we incur must always have a debit balance. The owner's equity, the money that we invest into the business must have a credit balance, and always our revenues must have a credit balance. When we know all these things and prepare the trial balance, it will help you so that when you realize that you have gone to put cash, you've gone to put cash as a credit balance, then it's wrong because cash is an asset. So definitely it needs to have debit balance. So let's all remember, so in actual liabilities must have a credit balance, and then all your expenses must have a debit balance. Likewise, your equity, your owner's equity, that's the money that you've invested into the business, and then your revenue, all these must have a credit balance. Now let's look at an example of a trial balance. I'm going to take them one after the other. This is someone's trial balance. This trial balance was taken from the general ledger. So in the general ledger, the person had an account for land and buildings, had an account for furniture and fittings, had an account for machinery and equipment, had an account for inventory, had an account for debtors control. That's the same as accounts receivable. That's money that you're receiving from your debtors. The person also had a bank account, not a bank account that's the one in the bank, no. The person also had a capital account. The person also had a loan account. Maybe you took a loan from a bank. Creditors control, money that you owe your suppliers. Sometimes we get our goods on credit basis from our suppliers. We have sales accounts, we have sales return. Sometimes the goods that we sell to people, they return the goods back to us. Because of some 1 or 2 issues that might come. It depends on the kind of principle that you have in an organization. Some organizations might not accept the of sales, or sometimes to people work on commission for you. Okay, so back. So the cost that we incurred in putting our product together, that's the cost of goods sold. Advertising expenses, membership fees, probably you are part of a group and you pay membership fees, water and electricity, telephone, salaries and wages, interest paid. So all these things are, we can say, are accounts in the person's general ledger. And these are the kind of transactions that the person engages in. Please, I believe we all understand someone can just respond on your behalf so that I can know that you all understand what is happening. Okay, I believe we can go on. Okay, so I have 2 raised hands. Okay, Elizabeth. Okay, I think we can go on. All right. So now we're going to take this thing. You understand?
Yes, please.
All right. Thank you very much. Now, let's move on. Okay. So now, let's look at the trial balance. Someone has raised his hand. Let me see. Okay, Cephas. Hello.
Hello. I also
Yeah.
understand what you are saying.
All right. Okay, thank you. Then I believe I can move on. Okay. Okay, so as I was saying, these details were taken from the person's ledger, general ledger. So in the general ledger, these are the various accounts that can be seen in the person's general ledger. So as I said, if you want to prepare a trial balance, it is when you sum up, when you close the account. So when we go to land and buildings, the person probably purchased land, maybe the person tries to build for the company or something. Okay, so the person purchased land and that's for the company. So as the person purchased land, the land and builders account will be debited and either our bank or cash will be credited because money is going out and we are receiving something else, that's the land and then the buildings. So at the end of the month, if we are closing our accounts, these are the sums that we got after closing the account. So land and buildings is 110. Furniture and fittings at the end of, and let's always remember, as I said, assets have a debit balance. So as you can see, all the assets, land and building, 2, 3, 4, 1, 2, 3, 4. The first 6 are all assets and they all have a debit balance. When we go to capital, capital can be likened to owner's equity, and we said it has a credit balance. It has a credit balance. So if in your trial balance, we see that capital is a debit, then there's an error. It's going to affect you. So always need to remember what I said about the 5 main columns and where each balance lies, or which the kind of balance they have, whether a debit or credit. So the 5 accounts, 2 of them are debit, 3 of them are credit. You can remember that. And assets and expenses are debit. The remaining are credit. I think using this kind of scenario will help us understand. All right. So that's just, by the way, that is the trial balance that we have. It will always come from, I can see some raised hands. Okay, Esther, please, you have a question? Okay, I think we can go on. Okay, I think we can go on. Right, so that's just it. That's the trial balance. So always remember that we get the trial balance from our general ledger. Okay, great. So we are done with the third tool of bookkeeping. So we now know journal entry. We now know posting into ledger accounts. We now know chart of accounts. We now know trial balance. So that's 4. We're going to the last one, reconciling our bank statement. Probably not every one of us has registered a company as a corporation. Okay, probably it might be a sole proprietorship. Even that, you shouldn't keep your person. Okay, all right. Please, who has a question?
Yeah, me.
Please, I'm listening.
With the assets, I don't get why assets should have a debit balance, because I was thinking with assets is something that you have. So if you have it, it should be credit, not debit. Debit is when you're taking something out of the account.
No, don't get it wrong. Okay, all assets generally have a debit account. Okay. And if your assets have a credit account, then you know there's a reduction in your asset balance. So for instance, let's take cash. Okay, cash is an asset. So all assets, you own the asset, they belong to you. So they are assets. Please, you understand? Or you still don't get it?
Okay. Yeah, okay. Let's move on.
Okay. Okay, so move on. But if you don't understand anything, you can just prompt my attention. I'll take it to. Okay. So, but then let's always remember these 5 things: that our assets have a debit balance. At the end of the day, that's what I'm saying, that when you are preparing your trial balance, this is the final thing, okay? But you know, we have cash and you can credit your cash. That is when there's a transaction. But this particular thing is referring to when you have totally closed your account and you are preparing your trial balance, okay? So if you are going to enter a transaction in your journal, let's say you bought something, definitely your cash will be credited because yeah, money is going out, a particular account is going to receive. But for this particular things, these 5 things I have stated here, they are for when you've closed your account, you have closed the ledger account, you have, at the end of the month, you are now sitting down to prepare your report, a debit balance, and all liabilities must have a credit balance. So these ones refer to when you are closing the account, not when transaction is going on. Because when transaction is going on, transactions happen. You can receive money, money will go out. But when you are done with everything, you're closing your account, always remember that your assets have a debit balance, your liabilities have a credit balance, your expenses debit, owner's equity or capital credit, and then your revenue credit. All right. Please, you're going to bank statement. And as I said, let's try to separate our personal bank account from our companies or our startups bank accounts. Let's try and create or open accounts for our businesses, because if we add them to our personal bank account, it's going to create a whole lot of mess, because you also have needs, okay, and you also go and withdraw for your own personal needs. So if from the same bank account, people are paying you, suppliers are paying you huge sums of money, and also withdrawing from the same amount to spend, it wouldn't really help reporting. Because at the end of the day, you might go and spend the company's money and you might be incurring losses you wouldn't understand, not knowing you are spending the money. And it won't be deliberate that, oh, I want to spend my company's money. No, but because the account is together. So let's always try, in as much as the business might be small, let's try to separate the account. Even if you can't open an account, let's say a company account for your business, what you can do is that you can create 2 different accounts. So one will be solely for your business and one will be solely for your personal items. So you can have 2 bank accounts, maybe, or you can even have in the same bank, you can have 2 different accounts, and one will be for your business, one will be for your personal needs, so that you don't always mix them. So we want to reconcile our statements. Every time at the end of the month, we need to reconcile our bank statements. When we take our statement from the bank and we take our cash book, we need to balance it. Our cash book, as we learned, is also an account in the general ledger, okay? And we know that in the general ledger, we have so many accounts. So this time around, with the bank statement, we are focusing it only on the cash, because the bank and cash are interrelated. We take money from the bank and then we use it for our operations. Okay, right. So that's how come we always need to reconcile our cash account with the bank account, and not reconciling our bank account with the whole general ledger. No. Even if you want to go and purchase something, it is done using cash or it is done using bank. So it's ideal that you always reconcile your bank account and then your cash book. All right, reconcile your bank statement. It is very, very simple. I'm going to give you about 4 steps in reconciling it. It might look quite cumbersome. But when I'm done, I'll show you a template and then my best to compile these things into probably a Word form so that I can share it, so that when you go back and you are working on it or you are going over, you can probably remember some of the steps. Because as I teach, maybe I might not get the time to write everything. So I'll try my best to compile them. But we might get this after the class, because my fear is that if I compile them and I bring them, it might prevent people from joining the class. So I have a Word document. I have it ready. But everything is together, right from the beginning of the class to the end. So if I share it right now, it will affect the attendance. And we also need our certificates. So it's important that we are punctual for class. Okay, so please, let's move on. At this point, do you have, okay, Elizabeth has raised her hand.
Yeah, actually what I wanted to say is,
Okay.
since like you're thinking about the attendance or something like that, why don't you rather make like maybe a small note on what you teach on this day, so that when you are done and people are not able to attend, that very small note, they can be able to know what we taught that day. You get it? Not necessarily
Okay.
means like everything or something like that.
Okay. Okay. All right. That's a
Yes,
good
please.
point. So I'll look at that too. That's a good
Oh,
point. Okay. Someone has also raised their hand. Okay, so let me check the person. Jeff. Oh, but as Elizabeth said, I think she's right. Maybe based on what we actually learned that day, I just put it on the page, and then it will just be for that day. Then if there are any assignments, you can look on them to assist you. So it means that right now I owe you about 4 notes. Yes. No, today's the 3rd day, so I owe you about 3 notes. Okay. All right. Someone wants to talk? Oh, it's fine. Okay, let's move on. We are almost done, though. Okay, so as I said, it's important that we always reconcile our bank statements with the cash account. And let's remember, please, always request for your bank statements from the bank. Some banks might give your bank statements to you at the end of every month. Some banks give it to you. Okay, so always ensure that at the end of the month, you are requesting for your bank statement. At the end of the month, you're requesting for your bank statement. Okay, so let's look at the steps involved in reconciling our bank statement. First of all, we need to take our bank statements. When we get the bank statement, then we take our cash book. This time we are looking at only the cash book. It's only the cash book we are interested in, because that's the account which deals directly with the bank statement. So when we take our bank statement, first of all, we need to compare deposits. We need to compare deposits. And let's remember, as I said yesterday, Anita mentioned, she asked the question about the debit and credit of our bank as being different from accounting. And I explained that yes, when you go to the bank, okay, and you take your statement, so the credit side is again to you, the individual, or you, the account holder. And the debit side shows the money have left the account, but our cash book that we have prepared, it is quite different. Okay, when we come to our cash book, all the debits are showing money that we have received. Okay, and then the credit is showing money that have left the company. So right now, let's say a supplier comes to you and pays you, a customer comes, sorry, and pays you money for goods provided or for services rendered. When the customer leaves, and let's say you've entered the transaction, you've done your journal entry. Now, when you're entering from the journal to the ledger, definitely you have debited your cash account because you have received money from your customer. You sold goods, you rendered services, so you received money. Now, when you're taking this money to the bank, that's per the accounting rule. But when you go to the bank and they are entering it into your system for you, when you get your statement, all the money that you put in the bank, all the deposits will reflect at the credit side. So with this kind of comparison, when you take your bank statement, you compare the credit side of your bank statement to the debit side of your cash book. Please, I believe we understand. Don't go and compare debit of your bank to debit of your card, and that you will be frustrated. You feel that, hey, where from all these monies? I've not seen all these monies. No, please. When you take your bank statement, the credit side refers to all the monies you have received. So always start comparing. When we start the comparison, always compare first. The credit side, all the credit sides, you want to see, okay, at the end of the month, per my cash book, I received 10,000 cedis. Now let's go to the bank. Per the bank, okay, there was a credit of 1,000, credits of 200, credits of 300, credits of, at the end of the month, all your credits, the credit that you received, that you got from the bank side, it should be able to tally with your debit side. If it doesn't tally, then there is an error. You need to correct that. You need to find out where that error is coming from. So that's the comparing of deposits. Sometimes your customers pay directly to the bank. Okay, you give them bank details. Oh, pay, I don't accept cash. I once worked with a company. They're not accepting cash at the office. They always use the bank. So what they do is that when you go to the bank and you go and pay, then you bring a deposit slip to the office. Then we record it in our cash book. I believe we understand. So that every time your cash book is updated, even if you don't receive cash at the office and you tell them to pay at the bank directly, tell them to always, because you need to issue them receipt, right? Very good. Before you issue them receipt, you need to tell them to bring a slip, a deposit slip of the deposit they made. And when they bring it, you now enter it into your debit side of your cash book. So that's where they're comparing deposits. So that you know that, okay, at the end of the month, per my cash book, I received 10,000. So, and unless, of course, the monies that you received, you spent some. Maybe you didn't bank everything at the bank. Okay. So for instance, sometimes you can receive money from a customer and from the same money you spend. Okay. So in that sense, there can be discrepancies. Okay. But they always make sure that you bank your money. You don't spend from the money that you receive. Okay. So if you receive revenues, don't spend from it. Every time, go and bank it. So that you can, these comparisons can be very easy. But if every time you get money and then you spend from that particular money, it might affect you. I understand some businesses might be very small, so you might not really have the luxury of putting the money in the bank and then waiting for, and then using other monies from somewhere. No, but what you can do is that to ensure that you are keeping good records of everything that's happening in the organization, when you receive money, you can look for days in which you bank all monies. It can be maybe Mondays or let's say Fridays. Then you bank everything. Then when you are going to take money from the bank, you know that, okay, I took money from this account. Then you can easily reconcile your account. But if you are taking money and spending from that money, reconcile the bank statement might be different. Okay. So that's the first point. The second point is that you adjust the bank statement. Right now we have compared the deposits. We are okay. Our debit balance in our cash book is matching with the credit in our bank statement. So you're okay. But when we are done with it, now we put everything down. Then we pick only the bank statement. We are now done with the comparison. Now we're going to take them one after the other. We will pick the bank statement and adjust it, and we'll pick our cash book and adjust it. When we finish, then we put them together so that we can ensure that our bank statement, the balance at the bank statement is the same thing as the balance in our cash book. All right. So with the adjusting of the bank statement, adjust the balance on the bank statement to the corrected balance. In doing this, you need to add deposits in transit, deduct outstanding checks or bank errors. Okay, so this might be a lot, but I have a template that's down there that shows what you have to do. I'll add it to the document I'm going to send you. So when you are there, you can actually sit down and then go over it. You might understand it better. Okay, so right now when you pick your bank statement, let's remember that sometimes your clients might come and pay you and they might issue a check. Maybe they issue the check to you 31st March. And as at the time that you were checking with your bank balance, that money had not reflected. Okay, so you need to adjust but then your cash book, you've already entered it that you receive money from a client, the person paid by check. But when you check a bank statement, it hasn't reflected because it's in transit. And sometimes checks from different banks take between 1 to 2 days, and from the same bank, it takes the same day. So assuming that your client paid you using a different bank, and the person paid you on 31st March, meanwhile, the bank, and you also need your statement as at 31st March. So you go in for a bank statement from the bank. When you get a bank statement, you will not see the check that your client gives you because it hasn't reflected yet. We term that check as a deposit in transit because it hasn't yet reached or hit your account. So that could be a difference between your cash book and then your bank balance. So you adjust it. Okay, you adjust it. And then also we have some bank, sometimes the bank also makes errors. So you need to go through the bank statement and see every single transaction. If the bank is charging you for, let's say, the bank will charge you for the services they've rendered. They can charge you for IBAN, let's say internet banking. They can charge you for checkbooks. They can't, okay. So you need to go through all those things in your bank statement and know that you have not been charged twice. Sometimes the makes an error, they will charge you instead of maybe like twice. So that's a bank adjustment. So that's with the bank statement, adjusting the bank statement. So the first step, you compare the deposit between the bank statement and your cash book. When you are done, you pick only your bank statements and then you adjust them. You look through your bank. Okay, is there any deposit in transit? Is there any outstanding check that you need to give out? Sometimes you've written a check to someone, the person, it hasn't yet been debited from your account. Okay, you've written a check, but the person hasn't received, the money hasn't been taken from your account yet to pay the person because of maybe different banks or something. All these are examples of adjustment that needs to be done. So remember, deposit in transit, maybe a client depositing money to you because at that time it hasn't reflected yet. You too, on your part, you can issue a check to someone. Maybe you issued a check 30th March, and you went for a bank statement 31st March. It might not have reflected because of the different banking, because of the different banks that both of you use. It will take time before your account is cleared of that amount. So you need to, but because you've already stated all these things in your cash book, it will help you to adjust your bank balance so that you know the original balance there. Because sometimes your balance can be less, your balance can be 5,000 in your bank account. But what if you've already signed a check of 2,000? So ideally, your account should be 3,000, but you're saying 5,000 because of what? The outstanding check that has not yet been cleared. So when we take our bank statement and we go through all these things and we look at all the deposits in transit and then the outstanding checks, we will be able to identify some of these things and then adjust our bank statements accordingly. We can't always believe the balance as at the end of the month because there may be some entries or some clearances that have not yet been made. So when you take your bank statements, you adjust them so that if there are any clearances, you adjust them before and you can know that, okay, as it turns out, this is the money that I have in my bank, in my account. The bank doesn't have the same thing because it hasn't cleared the account yet. Then the third step is that right now we are done with adjusting all the things in our bank balance. We need to adjust our cash account. We now come to our cash account and we adjust it. Are there any monthly charges that we need to probably go and pay? Is there an overdraft fees? So you need to adjust. So when you take your cash book, maybe you're supposed to pay something of the month. You haven't paid yet. So when you pay, this is the money you're going to get in your account. I believe we understand. Okay, so let's say at the end of the month, our cash book is saying that we have a debit of 3,000 cedis in our cash book, but we haven't taken some monthly deductions or charges out yet. We need to take those things, of course. Whatever we do will be deducted from these charges, assuming that you have an insurance policy that you pay. In your cash book, you have to adjust it. If you don't adjust it and you assume that, okay, my cash balance as at 31st March is 3,000, and you don't adjust or deduct any monthly charges from it, when it's being deducted, you wonder where the money went to, and you think that, oh, money has left your cash balance or has left your cash without you knowing about it. No. So at the end of the month, if there are any monthly charges that you always pay, check them out so you can see the original balance that is left. So that's adjusting your cash account. So as you did for the bank, you adjust your bank balance, take into consideration all checks that have not been cleared, and then you adjust them accordingly. And then when it comes to your cash book too, you adjust it based on the deductions or monthly deductions that should have taken place that have not yet been taking place. So that's the third step. And then we go to the last step. The last step is now to compare the balances. Right now, at first we compared only deposits, and then later on we adjusted our bank balance to suit what it stands now based on examples, deposits in transit, the bank deductions, then outstanding checks. We've done that. Now we come to our cash book. We adjust it based on the current situation. We've taken out monthly deductions. We've taken out any expense that we need to take us at the end of the month. Now we know the original money that's left. Okay. So when we are done with adjusting all these books, then we now compare the balances. At the end of your reconciliation, your bank balance must be the same thing as your cash book balance. If it's not the same thing, they need to go over this process again, unfortunately, in order to get a reconciled amount. I remember about 2 months ago, we were reconciling our statements at work. My colleague was in charge of that. He reconciled and reconciled and reconciled. It wasn't balanced, but the thing has to balance. Your reconciliation, your bank reconciliation has to balance because you need to file them probably as a company like ours. Because of auditing and all that, we need to file our bank because when auditors come, they'll ask for all your bank reconciliations at the end of every month. That's what I'm saying, that it's important that you always reconcile your bank accounts, because if you have auditors coming in at your company, they'll always request for your reconciliation. And why is it reconciliation when it's not balancing? So we tried and we were able to figure out the differences. The issue was that there were some uncleared checks. We had issued checks to people, and then we had not factored it in our adjustments. That's how come our bank and cash book wasn't balancing. So we had to correct that error, and we were able to balance our cash book and then our bank balance. So at the end, no matter the kind of transaction that you run, at the end of the month, your cash book, because your cash book, it says everything about what's in your bank. So why is it not balancing? Unless, of course, there are some unclear checks. So when you make those adjustments, when you correct those things, then you are able to balance them. So finally, the fourth step, you compare all your balances. So I hope you remember these 4 steps. First of all, compare all your deposits. And remember that your cash book has a debit balance. Okay, any money that you received will be your debit balance in your cash book. In your will be a credit balance. And then also you adjust your bank statement, you consider all deposits in transit, all unclear checks, all bank charges. Then you come to your cash book, all monthly charges, all interest that you need to pay, anything that you need to pay around the month that you haven't adjusted it, you adjust it. When you are done, you compare your balances and it should be the same. So this is an example of a bank reconciliation formula. Okay, so balance as per the bank's books is there. Then there is the bank reconciliation. Then all unpresented checks, that is, it can be deposits, it can be all uncleared checks. Okay, so checks that have unpresented checks, checks that you haven't presented yet, you add them because they are coming to you. A client has paid you money, they issued checks to you, but you haven't taken the check to the bank yet. The check is with you. You need to add it because you need to know, assuming you are taking the bank, you have changed your bank balance. Because you're not taking it to the bank, that's how come it's different. You need to add it. And then any other credit direct bank, sometimes to then we take away debt yet. Those monies have not been received. So a client has signed a check for you've not received that money yet, or a client did a bank transfer from his or her bank to your bank. Once you've not received the money yet, you can't add it to your money. So that one is taken out. And any dishonored check, sometimes checks bounce, unfortunately, because of insufficient funds, or sometimes there might be issues with your dates. I also remember a time we issued checks. Checks take 6 months before they expire. But unfortunately, we wrote 2019 on our check. So when the person took the check to their bank, the person could not withdraw because it was 2019 February, and when 2020 February, that's 1 year. So it was a dishonored check. So in our bank reconciliation, we can't add that. We need to take that off and other items. So at the end of the day, always remember your cash book account must always balance your bank statement. That's why it's important that you don't mix your personal account with your business account. So when you're withdrawing money, it's easy. You can be able to monitor it very, very, very well. So we are done with today's class. So today, I believe we've learned a lot of things. We just continue with about 3 tools of bookkeeping. We learned about chart of accounts, and we said that the chart of accounts, we take all those accounts in a general ledger and we put them together, we number them, we categorize them into assets, into liabilities, into expenses, into revenues. Then we are done. We have a trial balance. If we really want to prepare our financial statements, we need a trial balance. And that is the closing amount at the end of every ledger account. So we take the closing balance at cash, closing balance at revenue, closing balance at equipment, closing balance at debtors, closing balance at the payables account. We bring them all together to form a trial balance. And we said that in our trial balance, all assets have a debit balance, and all expenses have a debit balance. The remaining 3, that's equity, or let's say capital, owner's capital, revenue, and then liabilities. They all have credit balances in our trial balance. And we went ahead to also look at what bank reconciliation. It's important that we always perform bank reconciliation. So I'll be happy if you could take time, probably go and take 1 month. Maybe you've not started, you don't really have a structured cash book, but let's use the month of April, okay? At the end of the month of April, let's request for our bank statement. Let's take our cash book and let's try to reconcile them. If it's not balancing, let's consider the factors that we have. It can be unclear checks, maybe some errors at the bank. So you adjust all your statements, and then you can be able to have a reconciled statement. As you rightly said, I'm going to try as possible to share what we've done so far with you, so that some of the steps like this, you can always remember them. So that when you're going back to reconcile your books, you can follow these steps. Please, is there any questions? Is anyone having any questions? Please, do we have any questions? Do we have any questions?
Yes, yes, please.
Okay.
I think it's not a question directly related to this, but then we sent a suggestion, but it's like you've not seen it.
You sent a suggestion.
Yes.
Okay. Is it concerning the documents I sent you after class?
No. It's concerning the double
okay,
entry.
Okay. I'm listening.
It's in the chat. What do you call it? Windows. So perhaps because it's like most of us are a bit confused, because for those of us who are not coming from, haven't had it, from the layman's point of view, we only know it to be one entry procedure. But then now we're being introduced
double entry.
So we kind of a bit of, if you could, at the end of this, just a quick summary, double entry procedure will be very, very grateful.
Okay. All right. So let me go over the double entry again.
Exactly.
So every transaction, there for every transaction, there are 2 entries. That's what we need to remember first and foremost. But always remember, for every transaction, there are 2 entries. So I can give you an example. Let me give you an example. I always use this example. we're going to pay our rent. Okay, let's say in your transaction record. Okay, so rent means that two things are involved here. How did you pay the rent? Do you use cash? Of course, either you use cash or use check. Okay, so let's say you use cash. Now you are going to create two accounts from this transaction. The cash account, that's where the money left, and then the rent, where the money went to. Okay, so that's how come we have two accounts over here. That's how come we have the double entry. So because we've identified two accounts here, what do we need to do? We always say that what you debit your receiver and you credit the giver. Who was the giver? The company was the giver. The cash was our cash. So we will credit our cash. Then who received the money? Rent received the money. So we'll debit our rent. Meanwhile, you might think it's just one transaction. Okay, we paying rent. That's all. Cash going out. That's all. We paid rent. That's all. No, it has to be two. So for any transaction, try and identify two accounts in there. Please, Abdullah, do you understand or you still are confused? Pardon? Oh, I can't hear you. I
said,
so
I'm now getting.
Okay. So always remember, for any transaction that you have in your company, the account that you're going to draw from it might either be two or even three. For instance, you took cash, all right, but you paid for about 4 things. So that is like 5 accounts. So let's say you took cash, you paid electricity, you paid staff, you bought stationery for the company. These are 3 things. So cash account, that's the credit one. And those receiving are your staff receiving your money, electricity receiving, and stationery receiving. So you're going to debit all those who receive the money. So staff, electricity, stationery, they all received. So those are what debit entries, because they are receiving. And then the credit, the cash is going out. So how many accounts have we generated here? About 4 accounts. So for every transaction, that's why I said the first step is what? Analyze the transaction. When you analyze the transaction, then you identify the account in there. Then when you analyze the transaction, always remember the receiver is debited and the giver is credited. That is. Any more questions? Please, I hope you are on the assignment. I hope everyone is on the assignment. We are all having the assignment. And then, if you have any issue, kindly reach out to me. I'm available, okay? I'm more than willing to assist every single person here because we are all learning. Okay. All right, so that's about today. So I'm going to compile what we did from Monday through to today. Then I'm going to share, as I've promised, I have to share it with you. I'm going to share it with you. Okay. If I do it that way, it will be better. So that when you go over and you're revising, and probably doing the assignment, it will help you. Okay. So that's the end of the class. Thank you so much for making it a point to come to class. Okay. I'm excited you are all here. So, and trust you me, we are going to go through this thing together. You're going to understand the basis of accounting, because it's important that as startups, as businesses, we are going to expand on it. So we need to inculcate that habit of accounting right now so that when we get to that stage where our companies are big, we don't have issues with bookkeeping at all. Okay, so luckily for today, we didn't have any internet issues. So maybe we will discuss on the page if we should try the 8 to 9 or tomorrow, or we should still go by this. So we'll discuss on the page, and then please, everyone here should give your feedback because it concerns you. All right, so thank you very much and have a lovely day. And as I said, I'm going to send the documents to you right from lecture 1 to lecture 3 so I can help you. Okay, so take good care and have a wonderful day. Bye-bye.
Please, when is the last submission for the assignment? Or anytime you want to, then you just submit.
Okay, so from now to Friday. Friday is the last day because I have another assignment. It's a build up on this.
Okay.
So Friday after by 12 noon, we should submit the assignment so that I can also give the second assignment.
Okay.
All right.
Okay.
Thank you. Have a nice day. Bye.